Hey everyone, happy week of Thanksgiving. This Thursday, I'll be taking on my local town turkey trot. Some joker made it 5 miles instead of 5K, so yeah, we'll see how it goes. Anywho, this is one of my favorite episodes from 2025. We're calling these mostly classics, and it's with Andrew Casey, the CFO of publicly traded marketing analytics company Amplitude. Andrew is probably the most operationally focused CFO that I know. What you'll get from this episode is a deep dive into building deal desks and empowering your sales reps to go out and crush it. We also talk sales comp and the importance of reading the fine print in contracts as a CFO. Finally, we talk about his time working for Mike Scarpelli at ServiceNow and what he learned from Frank Slootman along the way.
We did this survey and I had this slide I was presenting and it had what the feedback was from our sellers on what they thought where they should be spending their time. How much time do you think out of 100%, how much time do you think they rated prospecting?
Probably not much.
It was 0.
Zero? We don't do that here.
But this notion was that they didn't understand that when they were the primary interface with the client on all commercial transactions, that it was logical for them to be the ones who are actually doing the opportunity discovery on potential expansions.
Is this thing on?
Yesterday's price is not today's price.
Welcome back to the Run the Numbers podcast, where you will find if you're an important person and I really want to have you on the podcast, I'm like a dog with a bone. I will follow up over and over again. I asked Andrew probably for 2 years to come on the pod, and I finally got him, folks. Andrew Casey, CFO of Amplitude, who just subtly drops on the podcast, which I didn't know, that his wife is the CFO of Sonos. Like, mind-blowing. It's like the CFO power couple of the century. But nonetheless, today's guest has helped scale 4 SaaS companies: ServiceNow, WalkMe, Lacework, and Amplitude, each in the same journey. Find product market fit, then ask the bigger question: can we go upstream to the enterprise? It turns out everything changes when you do. Go-to-market strategy, the sales process, how you structure deals, even how you define customer value. Our guest, he's been through the center of it all: building deal desks, rewriting contract playbooks, aligning pricing with actual outcomes, and teaching sales teams how to sell not just the product, but the solution. He's also not shy with the contrarian take or two, like why consumption-based pricing may be more headache than hero for enterprise SaaS, or why auto-renewals might make you look like you're in the bush leagues. We'll talk about operational maturity, shifting a company's DNA to serve complex customers, and what it really means to be an operational CFO. Andrew is certainly an operational CFO, one who started in corporate finance, not accounting, and still leans in hard on customer value, not just closing the books. Oh, and he once had to report to 2 legendary execs at the same time: Mark Scarpelli of Snowflake and David Schneider, now at Coatue. Both of them were running operations and finance at ServiceNow at the time. I can't imagine that reporting cadence. He did it for 6 years. Yes, really. All right, all this and much, much more after a short word from our sponsors. You just launched a new AI product. The new pricing page looks great. I'm talking crisp. But behind it, last-minute glued code, messy spreadsheets, and running ad hoc queries to figure out what to bill. Customers get invoices they can't understand. Engineers are chasing billing bugs. Finance can't close the books. Well, with Metronome, you hand it all off to the real-time billing infrastructure that just works. Reliable, flexible, and built to grow with you. They turn raw usage events into accurate invoices, give customers bills they actually understand, and keep every team in sync in real time. Whether you're launching usage-based pricing, managing enterprise contracts, or rolling out new AI services, Metronome does the heavy lifting so you can focus on your product, not your billing. That's why some of the fastest growing companies in the world, like OpenAI and Anthropic, run their billing on Metronome. Visit metronome.com to learn more. That's metronome.com. This episode of Run the Numbers is brought to you by Mercury, business banking for founders and finance pros who want their financial stack to actually work together. Now, I don't plug tools I don't know or intimately use. I've been a Mercury customer for a couple of years now. In fact, I showed the Mercury dashboard to their CFO, Daniel Kang, from their finance team right before we hit record on this episode. It felt like a full circle moment. And what I love most is that Mercury isn't just banking, it's operational confidence. I can send a wire to a podcast editor, I can check capital balances, and I can approve a payment for a freelancer who helped me with a tech stack report, all without bouncing across tabs or praying a PDF exported correctly. Mercury is making a bet on builders. Whether you're issuing your first invoice or wiring 7 figures for a warehouse build-out, it's banking that scales with your ambition. Visit Mercury.com to apply online in minutes and see why over 200,000, entrepreneurs choose Mercury to run their business finances smarter. Here comes my banking voice. Mercury is a financial technology company, not a bank. Banking services provided by Choice Financial Group, Column NA, Evolve Bank and Trust, members FDIC. The IO card is issued by Patriot Bank, members FDIC, pursuant to a license from MasterCard. All right, I got to get up on my soapbox for a sec here. Everybody's talking about AI-powered this and automated that. But here's the thing about revenue recognition. It's not just about moving data around. It's about getting it right, full stop. So RightRev is laser focused on one thing, RevRec that auditors actually trust. See, there's a difference between automating revenue processes and automating revenue recognition correctly. RightRev was actually built by the godfather of RevRec, who understands ASC 606 compliance, audit controls, data validation, and the flexibility needed for complex B2B contracts. We're not trying to be your billing system or your ERP. We're the revenue recognition engine that sits between your contracts and your financials, making sure every dollar is recognized correctly, on time, every time. Companies like Snowflake and Logic Monitor don't just need fast revenue reporting, they need revenue reporting that's audit ready from day one. And that's honestly where RightRev shines. And what I love about RightRev is they're not out there trying to be everything to everyone and just slap some, AI slop on top of it. While everyone is building these massive platforms that do everything in a kind of mediocre fashion, RightRev does one thing exceptionally well. They make sure your revenue recognition is bulletproof. Ready to stop gambling with your RevRec? Visit RightRev.com to see how we make complex revenue simple. That's RightRev.com, where revenue recognition actually works. Andrew, welcome to the Run the Numbers podcast.
Thank you, CJ. I really appreciate you taking the time to talk with me.
Having you as a guest really gives me perspective. It reinforces persistence, because I think I've chased you for over a year and a half. So anybody out there, if you're looking to send that cold email, just keep at it, and one day you'll get a public company CFO like this in your podcast.
Well, there has to be a good content behind it too, because like I told you, I've been a big fan for a while. You amplify, no pun intended, some of the things that you try to do as a public company CFO and really driving change and driving scale in our business. And, just suffice it to say that persistence is one that kept you at the forefront of, I'm going to have to do this at some point, because one, I want to be part of this and say how much I appreciated the learnings you're putting out. But two, that the timing just wasn't right. As you know, I had gone through a couple different transactions, and it was just never right timing. But now that I'm at Amplitude, it was the perfect timing.
Well, timing is everything, and it also gave me a lot of time to keep digging into your bio. And one of the things that struck me, and why I wanted to have you on, Andrew, is you're one of the most operationally focused CFOs that I think are out there. Maybe you could just give a bit of an overview on what led you to be so operationally focused, because a lot of CFOs, or what people think are CFOs, are just traditionally balance sheet and P&L people. But I mean, your career ranges from pricing to packaging to deploying quota. So maybe you could just touch on the early days.
So it's you're right. I think that the early days of my indoctrination in the corporate world had really left an impression on how I think even today. And I'll start with, simply when I came out of my undergraduate, I went in, I was hired as an accountant. Remember, I'm hired as an accountant. And it was part of a management rotational program. One of the first things they did was they put me on the customer service lines, answering customer questions, answering the phones. And I can tell you, that's a hard job. I had a lot of empathy for the people who have to do it, but it immediately threw me into solving customer problems, trying to figure out issues, and really having customer empathy. And that really catered to a lot of my thought processes. Even as I was going into my master's program, while I was working, I was at the Peter Drucker School of Business, which is, where I met my wife, who is now the CFO of Sonos. But the thing that I learned through Drucker's training was that, you really have to focus on driving customer value. I mean, he's got 5 principal questions he asks companies when he interviewed them. Is like, what's your mission? Who is your customer? How do they get value from what you're providing? And it was permeated everything that he talked about. And it just made a huge impression to me is then I went on to more and more experiences that you really have to understand, that customer perspective. Now, the other thing that happened to me was when I first went out of my graduate degree into Sun Microsystems, they really, really wanted people to have a broad base of experience. Some companies, they foster technical competence and moving through specializations. If you're a tax person, you're really good at tax. If you're in supply chain, you're really good at supply chain. But Sun Microsystems really was a company that wanted you to rotate in lots of different disciplines. Understand how the product was built, be in corporate finance, be in sales finance. And I even got to do investor relations at Sun Microsystems. So that rotation helped build my business acumen. And it just gave me a focus that you've got to understand the business context. You've got to understand how to make the right decisions by bringing in a lot of different perspectives. And even today, I would tell you that as I've taken on roles, in many cases, the CFO's roles where I've taken on the role of organizations that have sales operations or pricing and packages you mentioned earlier, it's just given me a perspective that you got to have the business context in order to make great decisions. And today, when I hire people, I try to hire them in places where they can begin their career and really understand the business first, and then rotate and get different experiences.
Well, first of all, I got to call out that you're like the CFO royal family there. That's amazing. Second of all, you kept saying customer, and I really like that we're starting the podcast this way, because there's this perception that CFOs, right or wrong, have like a distance from the customer. They don't know the customer's needs because they don't talk to them enough. How was making those first scary calls at the beginning of your career? How did that impact how you think about staying close to the customer now that you're at the top and you're the CFO?
Maybe it had its foundations in this notion that you've got to go generate customer value. And I really wanted to understand how each business that we were doing that. But even when in Sun Microsystems, I was helping sales initially construct deals, and you got an understanding of how they operate and why they chose you over the competition, and what value they were trying to solve, what business process they were trying to drive more efficiently, how they were trying to automate, how they were trying to become more competitive. It was always this thought process that how are we helping them? Because if we're helping them, invariably they're gonna choose us as the strategic partner they want in their business going forward. So it probably started a lot there. And then fast forward to my time at HP, and I came at a time that was very tumultuous for HP. Like 2 weeks into my tenure is when Leo Apotheker was fired as the CEO, and there was a lot of people moving around. And I was, at that point, I was brought in to help HP manage the EDS business, because they really didn't understand how to manage a big IT outsourcing business. And we were losing money left and right. And then the services leader that was my partner came like 3 weeks after that and said, I just got fired, so you're going to have to be on the forecast call. And so good luck. And it was a mess. It was a mess. The business was hemorrhaging. There were really bad contracts. And I remember telling my wife, after getting screamed at during the forecast call that my results were not acceptable, that I might have made a mistake. But the reality was they paired me with a really, really operationally savvy and strategic leader in Dennis Stolke, who was a veteran of EDS and had really known how to build great customer relationships over long periods of time. And so we rolled up our sleeves and got into every major contract that was a problem and started negotiating different ways in which to solve and improve the profitability. To this day, I tell people that there's one client in particular that when we dug into the contract, we noted there was ability for us to cancel if they didn't pay within the time parameters. And I was waiting and waiting and waiting. We were losing like $40 million a year on this contract. I was waiting and waiting. And when they missed, I immediately fired off that notice that, hey, we have the right to cancel, and we are. And to this day, they probably have a picture of me somewhere with a dartboard, because it was a very, very difficult contract, and we were able to get out of it. In other cases, it was about trying to figure out how we really drive the right outcomes for the client and remediating issues that were just done poorly on constructs and pricing, which we can talk more about some of the things around, how when you build pricing that's specifically towards customer outcomes, the pitfalls on that. But yeah, it was a lot of work to try to get in the right spot, but it helped me cut my teeth on negotiations with some of the largest companies in the world, because EDS had some really, really big customer contracts. When I left HP and I went to ServiceNow, one of the better career steps that I made, and I joined Mike Scarpelli and David Schneider and Frank Slootman on the journey that was ServiceNow. And I can tell you when I joined, a lot of people in my close network were asking me, why the heck would I go to such a small company that nobody's ever heard of versus, sticking with HP and working for Kathy, Les Jack, and others. But it was a great decision. And when I joined ServiceNow, I actually took on the role of sales operations leader. Mike wanted a finance leader to pair with Dave to really try to drive scale and repeatability and a little bit more rigor in the sales processes. And that's what we did.
Yeah. One of the benefits I have as a podcast host is I get to try to link together all these coaching trees and where people came from. And I mean, the Mike Scarpelli and Frank Slootman coaching tree is second to maybe like Mike Shanahan in the NFL. But I also get to see like where people who have these impressive backgrounds worked at places potentially at the same time. And I believe Charlie Kevers, CFO of Coatue, was at HP, and he was running investor relations when they went through like 4 CEOs in like a 3-year period or something.
Yeah. With Carly, and then with the transition over to Leo and others. And there was more drama there than you really wanted.
Hey, thanks for listening. We'll be right back after a word from our sponsors. Did you know that around 40% of manually processed invoices contain errors, missing data, bad codes, duplicates? And those mistakes don't just slow your finance team down, they cost you money. That's why global finance automation matters. It's not just about saving time, it's about keeping your business safe from costly errors. And that's exactly what Tipalti does. Tipalti is the serious AP solution for serious business. Tipalti automates the end-to-end payables process, handling everything from onboarding suppliers to global payouts, all so your finance team can breathe again. More than 5,000, of the world's most ambitious businesses already rely on Tipalti to make payments in over 200 countries and 120 currencies. With baked-in security and tax compliance, Tipalti gives you the confidence to scale globally without adding extra finance headcount. Give your finance team their time back. Don't let bad invoices drain good money. Visit tipalti.com/run-the-numbers. Tipalti.com/run-the-numbers. Tipalti, serious AP for serious business. So if you listen to this podcast, you'll know that I am incredibly passionate about the FP&A space because that's the route I went to get to CFO. And I want to tell you about a tool that has exploded over the past few years. It's called Aleph. And I remember getting outbounded by them about 2.5 years ago, and I actually took the bait because they claimed to be able to do a demo with my live data, with me right there on the call. And so I had to see it to believe it. And it was the founder running demos back then. Shout out Albert, hope you're listening. And he connected my NetSuite and built my P&L using their Excel add-in in like 15 minutes. And I was really impressed. Since then, Aleph has gone on to raise money from some of the top VCs out there, and they've built an impressive roster of customers. Many of their customers have been on the podcast, like the CFO at Turo, 8 Sleep, and Zapier. They're all really big champions and supporters of Aleph like me. But it's not just an Excel add-in. Aleph also allows finance teams to work with their live cross-system data using Google Sheets and their web app. And that's cool because it gives teams the option to support a wide range of needs and workflows like budgeting, forecasting, and variance analysis. And speaking of variance analysis, they're doing some really cool things with AI-powered variance analysis. It basically allows you to figure out what's going on and why, and it takes the time that you'd usually spend from hours to minutes. It's really cool. And so I highly recommend checking them out and taking them up on that demo or trial, just like I did back in the day. And you can learn more and get started at getaleph.com/run. That is getaleph.com. aleph.com/run. Tell them CJ sent you. A messy or missing cap table might not just slow you down, it could cost you your next fundraising round. VCs get flooded with pitches, and if your equity is confusing or missing, they'll move on fast. Fidelity Private Shares is an all-in-one equity management platform that helps you maintain a clean cap table, an organized data room, and a clear equity story. Schedule a demo at fidelityprivateshares.com, mention mostly metrics, and get 20% off. But pressure makes diamonds. I think there's something to be said, though, about these smart people like yourself and Charlie who run towards a market that's like, this is challenging what we're doing here. And then you get to do things that maybe earlier on in your career you wouldn't have had the chance to just because nobody else wanted to do it.
I agree. And I did have extensive sales operations background when I went to ServiceNow, but Mike and Dave and Frank all thought that had the right set of skill sets and experiences, and that notion of I've touched different organizations. So I had a really good broad base of experience to bring to the role. And, I tell people when I joined ServiceNow, despite the fact we were almost 400 million in ARR, we didn't really have a great comp plan structure, go to market. There was no partner ecosystem, pricing and packages all over the place. We had what we called the dirty dozen on contracts that had really bad clauses that you never want to do as a public company. So there's a lot of work to do to get us to scale. And for the first year, it was, we kind of went level. We didn't see, a lot of appreciation in the stock value. And it was a tough culture. It wasn't one that I often told my wife, I don't know if I'm going to make it. Because Mike and Dave and Frank, they all came from the data domain background, and there was a tight leadership culture that I was coming in proposing a lot of different new things about how our sales processes should work, and there wasn't a lot of trust established. But there was a key point in the evolution of ServiceNow where we had finished Q4, had a great Q4, went into Q1, and I was kind of sounding the alarm bell on the pipeline coverage and maturity that we had. And some of the analytics that I was trying to implement into our sales processes, they were just not flashing bright green. They were flashing bright red. And yet I still wasn't getting a lot of attention from the teams. So at the end of Q1, I was on my way up to Tahoe and trying to decompress a little with my family. Dave Schneider calls me and says, we missed the quarter, as you know. And Mike and Dave, they want to know why. And I said, okay, I've got the basics of some of the things I've been talking about in the pipeline coverage and how we should have better positioned this, and it would have influenced our guidance process more. And so the short answer was, I'll put something together. I could probably have it ready by Monday, Tuesday morning, after the weekend. He said, no, they want to see it tomorrow morning at 9:30. And so I looked at my wife and told her, look, got a choice. Stop now and we turn around, or you guys go on, and I get a car and I go back. I got to get this done tonight. And, when you have a great partner, she said, turn it around, let's go. And I went back. It was about midnight, worked all night. Next morning, went in to present to Mike and Dave, and I had not a large presentation, but it was one that actually showed that our Q4 to Q1 typically has this issue. For some reason, we hadn't connected the guidance that this linearity shift that happens between Q4 and Q1, and because we had such a strong Q4, a lot of the mature pipe had been already booked, which isn't a bad thing, but it just puts a lot of pressure on trying to get things done in Q1. There was a host of other things I mentioned as well. And afterwards, Frank looked at Mike and said, well, what do you think? And Mike said, we just hadn't looked at it this way, but what he's talking about makes a lot of sense. And so after that, we started implementing some of the changes that I had recommended, and we never missed another quarter.
There's this quote from Wall Street, the movie, that life comes down to a series of a couple of interactions. This is one of them. Do you think you had a couple of those moments in order to work your way up into like the trusted circle at ServiceNow?
Oh, for sure. And I think that there were times too, we were, they didn't know that I was a really good negotiator and how I could teach the sales team to really put the right types of deals together. And I started creating these presentations about how best to structure deals. And I started giving them to the sales team, and then word started getting around that I was doing this. And Dave Schneider had transitioned to president, and Kevin Haverty had come in to be the CRO. And Kevin said, hey, I hear you're doing all these trainings. Would you mind sharing me what you're doing? I said, sure. I showed him. And afterwards, he looked at me and says, I got to get the enablement team over to you. We got to film you. This is exactly what we're trying to get instilled in. And he said, you did it in such a way that the sales reps can see how, if they act the right way, that they're going to get paid by actually executing on the strategic objectives we have. So I have to get you out there and train them. And so I started doing that, and that proceeded in creating a deal desk, and I tell people, I've done this a couple of times in ServiceNow. Was my second time, but the response is usually the same from the sales managers. Like, great, finance getting involved in my deal.
Yeah.
One more stop along the way. Thank God, Andrew. But what happens is you start showing real value, and how when I got involved and we started doing some of the constructs, that the deals would get larger, and the sales reps would be the ones who were, exceeding their quota and getting into accelerators, which is great for the company too if you've aligned your comp plan the right way. And then all of a sudden that sentiment changed pretty quick, and they were asking me for not just more of my time, but they wanted me to hire more people so they could have more of that capability deployed in the field.
Andrew, I want to dig into that because you've seen both the good and the bad of enterprise contract negotiations. What's your philosophy on structuring a deal that's really a win-win for both sides?
So there's a couple of things, and it kind of depends on the company you're at, the level of maturity your products are, the level of maturity of the customer. But let's take a classic enterprise sale where your products are proven, they're good and strong, and there's a good value proposition. The thing that I tell our sellers is I construct negotiating deals in our pricing strategy around a couple of key principles. One is we want to incent their adoption, because likely if we built our product the right way, the more they use it, the greater value they get, right? So that's principle number one, and it's the most important. The second is that we should walk away from the negotiating table, and the customer should too, feeling like we had a fair value exchange. If the customer walks away from the table feeling like they got screwed out of the deal, or they don't feel good about the negotiation, and equally, if we feel like that the customer conversation was not one that was built out of a thought process of long-term partnership, then there's always this impediment to doing what I consider a great deal, a great engagement, one that's going to enable us to have lifetime relationships, irrespective, frankly, of, in many cases, if you're at the same company or not, or things change. If you feel like you walked away from that table and it was fair, then there's a lot that accrues in trust. And if your customers trust you, then you earn the right to have additional conversations. And so that fair value exchange is one. The other is, and this kind of finds its way into pricing, is, look, you got to have something that's transparent and simple for customers to understand what you're charging them and how that accrues to their value proposition. If there's opaqueness there, if there's a misunderstanding of what you're charging versus what value you're delivering, then there's always this question of whether they're getting the right deal. They're getting a fair deal, and they can't relate it to either the competitive marketplace or ways in which they're measuring that value. And I can give you some examples on that specifically if you'd like, but yeah, that area of making it simple and transparent is really, really important. And it colors everything that I've done around the different types we've done pricing transitions. The last is one that helps in the construct of deals, and that is that you're leaning into their value proposition. You have to understand what value they're trying to accomplish out of using your product or service, and you have to figure out how you can uniquely solve the problems they have and generate that value. And if you can do that in a construct, then you get a really, really good deal for both companies, for your company and the customer.
Andrew, what does transparency mean when it comes to pricing? And maybe you can go into it from a usage-based perspective, because you've worked at a couple companies that price that way. Because I actually believe that just understanding what you're being charged for, and then the ability to accurately forecast it as a person who's bought the software, two different things. So What's your perspective there?
So you're absolutely right. And Mike and I have had Mike Scarpelli and I have had this discussion a couple different times on consumption-based pricing. And I poked at him a few times that, I don't really have a consumption-based model from Snowflake, because the more I buy, the better discount I get. And then you're asking me to commit. That sounds like a SaaS agreement, not a consumption-based contract. But the thing that you're hitting on is really important, and that is that value understanding. Can I forecast it? Do I understand that as I use more, how I accrue value? Or if I use less, how that's going to impact my business? And I'll tell you a little bit of a transformation we went through at my prior company, Lacework. Lacework had a very similar problem with respect to, we're adding more features and capabilities into our platform, and we were marginally, incrementally charging customers for it. And it's what I call nickel and diming the customer.
Right.
And it's born out of this notion that product managers and engineering, they want to rationalize the work that they've done. They want to show some type of return. So they want to charge incrementally for it. Well, enterprise customers hate that, right? They don't want to be worried about every time they roll out a new feature and try to rationalize budget for it they want to use your product where its core intrinsic value, and they want to continue to expand because the more they use, it should accrue to value. So anyway, you're putting pricing barriers on that adoption, and it's just not a good construct. So we started going through a process of trying to understand what was if we were going to meter our usage versus a client, what's something that they would understand? What's something that they could easily validate from third-party sources? And one of the things we came across was every cloud provider, whether you're Azure or Oracle or GCP or Amazon, on your invoice, you'll get a translation into the number of virtual CPUs you've deployed. Okay, so that's the first thing. We decided that, wait a minute, we can charge on that basis too, and it'll be transparent on what their environments are. Now, Lacework, if you don't know, was a cloud security product. So the more cloud resources you deploy, the more you're going to want to secure them. So as your cloud footprint increases, you're going to have increases in your security. Okay, so that's a logical tie. But the other thing that was out there was we kept hearing from the industry, and customers kind of internalized that you should never pay more than 5 to 10% on security versus your cloud spend. So of your security spend, it should only be 5 to 10% of what you're spending on cloud. Like, okay, that's an interesting postulate. Let's test that with customers. Is that something that they think too? And by and far, every one of them said, yep, totally agree with that. So, okay, so if we can get to a meter that they can validate, vCPU, and we target our pricing, that proxy on value based on that 5 to 10%, then we have transparency that they understand the value proposition. And two, they can forecast it as their cloud spend increases. And so let's test it out. We deployed it. It was unbelievable adoption. 86% of our customers willingly transferred over to the new pricing because it was so much easier to understand. They could forecast it. It was transparent, and the value proposition was clear.
Andrew, when a company says I have a budget problem, how do you diagnose whether it's really a cash issue or an expense issue?
So it kind of depends on who you're talking to. Is it procurement? Is it a CFO? If it's a CFO, I would say, okay, I already know that it's an expense issue. They're more than likely in a negotiation, they're talking about their actual expense budget and how they're going to capitalize the contract and straight line it over the period. And typically, it matters the number of months in their fiscal period that they're actually budgeted for it. And so you can figure it out. But oftentimes it's pretty simple. You simply ask the question, like, let me just help them understand. So budget, are you having problems with your expenses and your budget and how much has been allocated for this project? And then, like if they say, well, no, that's not really the issue. Like, oh, okay. So is this just the payment side? And then you have to understand too, when is their fiscal period? If you're at the end of the year and they don't have any budget left, is there more budget that's available next year? Is that what you're talking about? So it's a little bit of probing questions. And I would say in a manner that is not, like they don't feel like they're under the spotlight and you're trying to hold them down, but just help me understand how best to solve what you're telling me is a problem right now. And oftentimes they'll just tell you. And once they start telling you the issues, you can start diagnosing what the right levers are for you to pull in a construct. If a customer is at the end of their fiscal period and they say they don't have any budget left, but they're telling me they've allocated budget for the next fiscal period, let's say that's a December to January timeframe, the construct is probably one where the start date is on January 1st, will help them align their budget effectively. And there's a thing that Mike taught me, and I've used every stop of the way, is that when you're recognizing SaaS, it's almost entirely pro rata over the contract period. And so one day really doesn't matter. Now, in enterprise SaaS and as enterprise software, invariably, we have very back-end loaded quarters. Even the best companies never really get more than like 50% booked in the first 2 months. And so you've got 50% that happens in the last month, if not more, in the last couple of weeks. And so even if you were normally booking a pattern of linearity, the revenue recognition you'll have in that particular quarter that you booked it is relatively low. So one day doesn't matter. And so the incentive plan that we've rolled out and I've rolled out ever since ServiceNow is one, even if the seller has signature on the last day and the start date is the next day, we'll count it. We'll count it because the revenue difference between that and ARR is very, very slight. It's just a one day. You can imagine that period to period, when people think about their availability of budget, and it's tied to that fiscal period. It's a powerful tool that sales can use in order to drive that alignment. So sometimes it's just timing. It's just making sure the alignment's there. Other times it's, aligned to how they want to roll out the project. With ServiceNow and with Amplitude in particular, we have multiple products that can take out other licenses that an enterprise might have. And they may have a specific time that those contracts are due, or they may have a specific project timeline that they want to adhere to. The more you can align the value that they're paying towards those replacements, that's an example of how you construct a deal that aligns to their value proposition and doesn't make them feel like they're paying in advance for it, even if you're giving them access to all the products up front. Because that gives them the incentive to go faster on those project implementations. And go back to the first principle I told you, we want to incent their adoption. So if somebody told me that they're going to buy Amplitude and they're going to replace their analytics package first, and then they're going to replace their experimentation in 6 months, I may construct a deal that aligns to that. That'll give them access to the experimentation now. And if they go faster on that replacement and they get value faster, that earns trust. If that earns trust, they're going to give me the next opportunity to go replace their session replay and potentially their guides and surveys, because I'm willing to work with them.
That, sir, was masterful, because I truly do think that there's an art and a science to pricing and getting the best out of your sales team. I'll call that the science of it. Now I want to go to the art, because you built out the deal desk at ServiceNow, and that's a big cultural shift. Can you talk to what you learned about incentives and how to get everybody to row in the same direction?
You know what? It's one, actually, I started that back in my Symantec days when I was first starting to write comp plans and understand the behaviors that you want to incent and how best to put those clauses into the contracts themselves. When we got to ServiceNow, there really wasn't much of a comp plan design. So I was working with Dave, and we started off with, well, what are the things and the behaviors that we want from our sales team? There's strategic objectives you want, because I like to tell people, you never sit down and write your comp plan first and then figure out the strategy. You got to figure out the strategy first, then build the incentives to go reinforce it. So one of the things we did even here at Amplitude is I pulled some of those levers around. Look, we've had a churn problem with customers that were oversold, and in many cases, I would say bad sales behaviors. And the incentive was for them, they could sell the customer as much as possible. They'd recognize as much of the commission up front as possible, but they weren't around for the renewal. And they weren't there to actually make sure the customer is successful. So we've changed a lot of those patterns, but the incentives now are one which they have the total responsibility for the commercial transactions at the account, including the renewal. And they're on a net new ARR quota basis. So if attrition happens in their values at the account, that actually is a negative attainment versus their new business drive. So that alignment was one that we implemented at ServiceNow, and it worked very, very well to drive the accountability down through the sales organization about, no, we want the customer for a long term. We want them to continually use our platform, and then we want them to try new products as we're innovating. We at ServiceNow, as it is at Amplitude, we have big aspirations for the products and capabilities we want to develop around our platform. So there's a clear understanding that we're going to add more products. And when you want to make sure that when we do have those products ready, the customers are interested and they don't feel like there's going to be a huge barrier to entry. Going back to, we want to incent adoption. So you got to make sure the incentives are driving the right behaviors in those interactions with clients. The other thing we told them was that oftentimes customers may have a longer term project and they'll want a longer term agreement in place. Our sales reps weren't even asking customers if they wanted to have greater cost predictability over a longer period of time and be able to have clarity on what those roadmaps are and line their contract duration up with it. Because the funny thing happens when you move from SMB, mid-market, digital natives to enterprise. Most of those SMB mid-markets and startups, they're trying to define their unit economics really, really finely. They're trying to make sure that every time that they spend something, that it's aligned to their revenue. That's what's most important to them. So they're not thinking about long-term duration contracts. They want to make sure that the contract they have is driving the right returns. Enterprises think a little differently. Enterprises have a bigger line item in their operations associated with inflation. They have higher line item costs that they want to try and manage, and they don't want to manage them every year. They want to manage them with predictability over a longer period. So they're willing to trade off committed duration with cost predictability. And that works really, really well for SaaS companies as long as you're not overly discounting, because committed contracts show up in your remaining performance obligations. And if those remaining performance obligations continue to grow at a rapid pace, you have lower and lower risk to your future revenue. So it's one of those things that you're training your sales team, you're training your customer base as you're rolling out more and more advanced products, have a longer term mentality about how you want to keep those customers, because what happens is a lot of times the expansion opportunities are much, much larger than the initial land. And that's what we're seeing. That's what we saw at ServiceNow. It's certainly what we're seeing now at Amplitude as well.
I want to talk about swimming upstream to the enterprise in a second because you've had a ton of experience doing that. But first, I want to get your take on multi-year deals as a CFO, both sides of the table. Love them or hate them?
So I would say if they're constructed with the right intent, like I was talking about, driving customer value over a longer period of time, that you've got the right frameworks that you walk away on, both parties walk away with fair value exchange, then I love them. I love them because it drives efficiency in the model from a sales and marketing perspective, and customers feel like they're getting a great deal and they have cost predictability in their models. So love them. Now, in SMB mid-market, a little different. It's a little harder to get that level of sophistication, but in enterprise, it's really, really resonates. And I've also seen it where, you got multi-year contracts and there isn't that good intent. And arguably some of the things we did at Amplitude early on with overselling, that they weren't constructed the right way, and customers feel like they came out of those contracts with a huge cost headwind as growth started to abate. So I think you really have to have the right construct.
What does being oversold mean? Because I've heard it thrown around on earnings calls before. I've read about it online, but I'm like, is it that you're overcharging them or you're promising features that aren't there?
So in the most egregious cases, you're overcharging them, and if you don't have good structures or transparent pricing, or there isn't a good market sense of what you're charging, without that rigor in the sales process, sales reps will go out and get as much as they can.
Yeah.
And, look, I love sales. I've been supporting them for most of my career, but they are influenced by what you pay them. And if you pay them without any types of guardrails with respect to ensuring customer value, then they will act accordingly. So it's overselling sometimes, and in the way that if you have a single product and there's a single value proposition, one way that sales will use is the discount lever. And the more you commit in volumes, the greater discount you get. And if during the period of zero interest rates and, go spend as much as you can because we have plenty of cash, customers were willing to accept and make commitments for much larger than they were using, expecting that their business was going to continue to grow at a very rapid pace. And so they were willing to make those commitments, even though there was a lot of liability that came with it.
Yeah. Coming out of the zero interest rate environment, I had this theory that there were going to be a lot of companies that looked around saying we shouldn't have committed to a multi-year contract. And then a lot of sellers who said, holy crap, I'm about to have a massive churn in 18 months.
Yep. Yeah. And that's exactly, unfortunately, that pattern had happened at Amplitude. And it's been, a good 2.5 years of working through it. We still have a little bit more to go, unfortunately, but yeah, it's a really, really strong lesson in trying to make sure that those multi-year contracts are beneficial for both parties.
It's a hard role to be in, man, because you want the short-term results, especially when you're public, but you also have to manage the long-term vision. So I feel for you there.
You know what? I will tell you, I always optimize for the long term. And I think if you do the right things, you get rewarded for that focus.
All right, maybe one more before we move on. Both seats, buyer and seller, auto-renewals, yay or nay?
I say, and I'm more enterprise focused, so I say nay. I don't like them that much. I mean, from efficiency perspective, actually, SMB mid-market customers like them because it's, unless there's a problem, they're happy to not have to administrate, a renewal process. If I'm forced as a buyer, as I'm forced into putting an auto renewal clause in the contract, I tell the procurement person once the contract is inked, like a day, a week later, send them a notice that we're canceling.
Yeah. And my perspective on auto renewals, and this has developed over time because I used to be super pro auto renewals, but if you're depending on auto renewals to hit your retention marks,
Yeah.
A, it probably means that you're not that confident in your product and customers would be happy. And B, just like personal experience, Andrew, I've never had a situation when auto renewals came up where people were happy that it was coming up.
Yeah. I agree with you. And so it's it's something that I think the machinery, transactional focused models had put forward, but it's not applicable for the enterprise. For the enterprise, there's other ways to make sure that you've got a framework that is customer friendly and gets to that fair value exchange in the contract, and it gives you some predictability on what the cost will be. One of the things so customers always tell me they want three things. They want standard SaaS clauses, they want flexibility and usage across our products, and they want that lean into my value proposition. So one of the things that you can do to provide a level of increasing renewal and have the customer feel like they've got a good cost hold on what that's going to be is by putting what we call a price hold on the contract. That basically says, look, if you're willing to agree to these same provisions at these same volumes, I won't increase your price by more than X. And that's a very friendly way to help get to that point. And my experience has been when you've done that and the customer feels and walks away like they've got cost predictability even beyond the contract period, because they're increasingly betting on you being able to provide value to them. That's a way of actually driving the same outcome that people who put the auto renewals in place tried to go achieve.
Andrew, in looking at your resume, you've been a part of some incredible rides through the enterprise, but I recognize that going to the enterprise is bigger than just saying we're taking on bigger customers now, we're raising our prices and packaging something differently. How does the go-to-market strategy change everything when you're scaling up?
So it'd be remiss if I didn't say, look, your product has to be there too. You got to have the security and role-based access and all the other feature sets that enterprises want in order to appeal to enterprises. You can't just say, I want to go to enterprise and there you go, just put a sales team in place. You got to have a really strong product that actually appeals to enterprises. Now, if you have that, then usually the march from SMB mid-market is taking a very transactional model and moving it from the manufacturing process, like everybody looks the same. This is how we should operate them. This is how we take our first discovery. This is how we negotiate the deal. This is how we close the deal. And this is how we move to customer success, on, to a more of a value-based sell, where you're increasingly relying on an enterprise sales exec to understand the customer's problems, figure out how you uniquely solve those problems, appeal to the champion, like you're going to make them successful, because if they invest in you, they're putting their career on the line to achieve an outcome. And so you've really got to work and build a relationship. And that's a skill that a lot of sellers just don't have. And you need to develop it. And sometimes you can take those transactional sellers and move them up, but a lot of times you got to kind of intermingle sellers who've had that experience to really drive a whole new culture change. And you got to have a sales leader. You can't have a really good seller. You have to have a sales leader. You have to have a David Schneider. You have to have a Kevin Haverty. You have to have a Thomas Hansen who understands that it is a long-term relationship that you're building. So that's the first step. You're changing the culture of sales fundamentally. And you're starting to adjust all the major processes you have. So what was before maybe a simple stage process with very simple criteria? No, now we're going through discovery. Now we're going through an MSA review, which is in some cases on the customer paper. Now you've got data protection and security reviews and often a POC and bake-off. These are all major steps that an enterprise will require before they're going to allow a technology like Amplitude to be run within their environment on their data. So that whole process changes the sales cycle. It's no longer 3 to 6 months. It can be 9 to 24 months long, depending on the organization and how significant the changes are for them. So you need to understand that that's going to be your selling process. And increasingly, you have to change your demand generation. It can't just be BDRs dialing for potential. You got to develop multiple ways. You got to have marketing campaigns that are both programmatic and field marketing related. You've got to create a whole new channel with probably your partner ecosystem. So the partners, and they take your technology and are implementing it with enterprises, they can show how to do the complex integrations and the workflow optimizations. So the demand generation has to change, and how you instrument the understanding of investments around which channel is the best and most optimized versus that. And you have to make sure that the sellers understand that, the expansion source of opportunities, it's them. It's them. It's no longer marketing. It's them who is actually doing the selling. I remember at ServiceNow, I brought in a consultant once to help us do some of this transformation. And not because we didn't know what to do, but rather because when a third party says it, people tend to think that it's more validated. So we brought him in and we did this survey. And I had this slide I was presenting, and it had what the feedback was from our sellers on what they thought that, where they should be spending their time. How much time do you think out of 100%, how much time do you think they rated prospecting?
Probably not much.
It was 0.
0?
0.
We don't do that here.
But this notion was that they didn't understand that when they were the primary interface with the client on all commercial transactions, that it was logical for them to be the ones who were actually doing the opportunity discovery on potential expansions, especially with new products where you're doing cross-sell. So there's that whole evolution in the processes themselves. And I would say, oftentimes you start to have an instrument, new ways of understanding how your pipeline and your dynamics are occurring, and what is affectionately called in the Valley is, we just have so much pipeline coverage, which if you don't know what that means, it's a value of your pipeline is X times that amount that you're expected to close in any given period. And when I first joined, there was certainly this notion that, you have to have a 3X coverage on your pipeline. Well, the more I looked into that, I said, wait a minute, that's not sophisticated enough. Because the amount of pipeline you need for an expansion where you already have an MSA in place, you already have a DPA in place, you already have a lot of these basic reviews done, the sales cycle should be shorter. So I don't think you need as much coverage if you're doing an expansion. But if you're going after new prospects, we know that those prospects can sometimes be very long in their sales. You may need even more coverage. So I started digging in and and this was early on at Symantec, but when I was digging in, I'm like, wait a minute, it really depends on where this exists. And we ought to start developing a thought process based on the individual pipeline at a lower level, whether it's new logos or it's expansions, to really understand what the potential conversion rates are and what if you have enough coverage in order to hit the number. And about that same time, we were also looking at the relative maturity of the pipe. And there's a lot of ways you can get a pipeline and understanding the velocity between stages and the conversion from one to another and all the different factors. And I immediately thought to myself, this is way too rich for sellers to understand. And not that they're not smart, but we needed to make something simple so they understood how the dynamics of coverage and maturity work together. So I developed this said, look, you need to understand that of your pipeline, there's a certain percentage that has to be late stage versus early stage. And the more you have late stage, the higher propensity you have for conversion, which made a lot of sense to sellers and managers. And so then I drew this chart that basically said, look, 6 months in advance of your target, it doesn't matter where you are in the sales territory. You could be at the global level, you could be at the local level, you could be the individual seller level. If you don't have X amount of pipeline 6 months in advance of your target, you're not going to make your number. Because we know as you get closer and closer to the quarter end, that pipeline falls. It falls in the level of coverage because you could have losses, you could have changes in value, you could have things that push, but pipeline coverage falls all the way down to what you actually close for the period. So if I said you need 4.5 times, the amount of pipeline in order to hit, call it $10 million, well, you'd say, well, you need $45 million in coverage, right? So equally, I said, I'm going to draw the line the other way too. It says, as you get further and further down the path of that 6 months, the relative percentage of your pipe that is mature in the later stages of your opportunity funnel, that should grow as a percentage.
Yeah.
Right? Makes sense, right? And so I then started teaching them, look, there's 6 months in advance, you're this month in advance, you're 3 months in advance. If you're not on that curve, you need to take action. You need to take action one way or another, because as a seller, you don't want to miss your number. And the only way to make sure you make your number is by working the right opportunities that are going to allow you to make the number. And that goes all the way up to the organization. So I started using this slide over and over again. And the funny thing is, I said I developed it kind of at Symantec, but I can tell you, the dynamics at every company where we've gone through this transition from SMB mid-market to enterprise sales, where the sales processes are elongated and the criteria and stages tend to be more sophisticated, I've used this as a way to help sales managers understand how they should be managing their sellers and to make sure they're on the right path. Because if they're above or below those curve lines, sales managers should be diving in and trying to help their seller the most they can to get back or above those curves.
You sent the slide over to me before this discussion, and what stood out to me is that it's not only not all pipeline dollars are created equal, it's not all pipeline dollars at certain points in time are created equal.
That's right. That's right. And it's one of those things that I just think it was underappreciated. Like that's where we started. And I tell you from there, then we started really, really getting more sophisticated, in our charts and information and democratizing the data for sales ops and for the sales managers. It became one of those things that you talk about rigor in the sales process and how we drove it. I mean, that basis gave us a framework that every sales manager could then have their one-on-one with their sales rep and say, look, I don't see you have enough coverage. I think of the coverage you haven't actually matured it much. What are we doing about that? Do we need a sales campaign? Do you need some marketing dollars spent? Do we need to do a dinner? Do we need to have some executive intervention? Like you start acting on it. You're not waiting for things to not show up. You're actually prognosticating what is going to happen if you're off those curves.
Andrew, I want to go back to something you said a couple minutes ago because it was something subtle, but I think it's extremely important in having a mindset shift selling to the enterprise. And you had said that from a buyer's perspective, a lot of them are betting their career on something being successful. And we'd spoken to Jeff Cooper, CFO of Guidewire, and they do these massive implementations at insurance companies, vertical software, where a CIO is sitting there saying, listen, I can bet my career and do this transformation now, or I can wait for the next guy in 5 years who will take my job and do it. But either way, like someone's ass is on the line if this goes good or bad. Can you just speak to that quality in selling to the enterprise?
Yeah, I think I crystallized that when we were when I was at HP and EDS was doing these big IT outsourcing. And you think about the CIO across the desk saying, I'm about ready to shift everything that I do for the company over to you with the expectation that you're going to do it better than me.
Wow.
And you really get to the point where you're like, okay, this is make or break for this person.
Right.
And if we don't feel that pressure coming through, then you're not as customer focused as you need to be, because the reality is you make and break careers that way. And through different companies, I'd say I've come up against this, at Lacework and at Symantec, it was security related, but you can imagine if there's a breach, that's like the worst thing for a company to have. And so I think it just starts to influence a lot of things you do about making sure that you're supporting them and their value accretion as much as possible. And it's different for different customers and different companies. But if you have that as your mindset and you take that on as you're accountable to it, it influences your decisions and it influences how you interact with those clients.
This may be a stupid question, but what defines enterprise? Is it simply just the number of employees that work somewhere?
I think that it depends on the company and how they approach it. But I tell you, there's a lot of companies who use that because it's the easiest thing for people to understand, especially from investors or when you're trying to do segmentation. There's a lot of information about the size of companies and the number of employees they have. You can use lots of different third-party sources to get to that information. And when I talk about like G2Ks, you could Google like right now and say, what's the average number of employees of G2Ks? And something around 58,000 or something. So it's a measure that a lot of people understand. And in a lot of cases, the purchasing power and the level of investments that those companies made is somewhat dictated by the number of employees they have. Now, I would tell you at Amplitude, we added another criteria, and it's because we kept looking at the proverbial 1,000 employees and bigger as the demarcation line for enterprise. But there was this really interesting conversation that Thomas and I had, and we're like, well, then we wouldn't be selling to Amplitude. And I said, oh, wait a minute.
Oh, wow.
Hey, you're right. but we're a significant company that we would want to target if we were selling that. We would want to target this. And he goes, yeah. So we need another measure. So we added companies who have over 100 million in revenue as well. So it's 1,000 employees or more, or they have greater than 100 million in revenue.
That totally checks out to me because like a year ago, OpenAI and Anthropic wouldn't shown up on like the enterprise register.
That's exactly right. So we wanted that barometer. Now, is it scientific? Is it consistent? No, it's not. You can go look at a lot of different companies and they have kind of different demarcation lines. And you want to have a loose approximation with your sales coverage so that there's scale in how you're reporting. If I'm saying we did X amount in enterprise and Thomas is saying something totally different to the company, people get confused, right? So we wanted to really agree on what that line was, and then it'll influence everything that we do. Everything. And the other thing for us, that line was pretty indicative of a big separation between the average ARR of the contracts we're getting, the contract duration, the gross retention rates, the net dollar retention rates. There was just this real segmentation that was happening below and above that. So that's the reason we chose those factors.
Andrew, I know I'm trying to boil the ocean here, but if you had to almost stack rank the things that you got to get right when moving into the enterprise, I mean, you got the people, you got the pricing, the packaging, just learning how to negotiate with enterprise clients. Well, what's first and foremost? What's most important to get right?
Well, I think the one thing you didn't mention, the product. I think the product got to be right. It's got to be right. Now, you could have a great product and not have any of those other things, and you would fail miserably. So it's got to be a combinatorial. I'd say Thomas Hansen, our president and COO, he started making the changes in our sales coverage to move more enterprise about a year and a half ago. And he was expecting that as our product matured, that enterprises, it would appeal more and more to enterprises, and he'd be able to sell more. But it was a leap of faith on his part to start that process, because typically you see it the opposite way, where you start getting a product, it starts landing in places, and wait a minute, this is something we ought to go invest in and build out our sales team. So it takes longer. So I give him the credit of having a little bit of foresight in this and starting the process, but it's still a learning curve. We still have to go get the right sellers in the door and all the other things you mentioned to really instrument the business the right way and drive scale. I believe that when you get those things working really well, it's kind of a self-fulfilling prophecy. You really start moving in the right direction.
Well, for everyone who's been hanging out with us for the last 45, 50 minutes or so, I think it comes through very strong that you're an operationally minded CFO, and you came up through corporate finance, not accounting. Well, I guess what's different about how you approach the CFO role because of that?
Well, too, it'd be a little remiss if I didn't say that I am an accountant. So I am a certified managerial accountant, and I do have technical competencies in those areas.
Better man than me.
But when I was starting my career, I really gravitated more towards the business and really using my technical capabilities to really help and drive the business objectives. And so every step along the way, I was looking for ways in which to broaden my experience. And I just happened to not go into the audit field. I was more, maybe by chance, but a little bit by focus. And as I progressed, I've kind of grown up my career, if you will, in the years when we had Enron and the problems and the need for a very technical accounting focused CFO shifted all the way back, because everybody was very concerned about Sarbanes-Oxley and audit capabilities and procedures. But over time, I think what the CFO role has evolved into one is a really strategic advisor for the business and somebody that the CEO can depend upon to give an unbiased perspective on the decisions that the company needs to have. And I think it's my absolute requirement that I lean in on many aspects of the business. I happen to have spent a lot of time helping sales because I think it's an area where I enjoy and I love talking with customers. But I was very involved in a lot of the acquisitions we did at Oracle when I joined right as we were ending PeopleSoft and all the way up through BEA. And you can bet I was very involved in the acquisition of Command AI here at Amplitude. So whether it's pricing and packaging, it's leaning in on our investments on the marketing side, it's deciding how well we should or not implement a new tool in IT. I think it's just really important that the CFO has a strong business context, because if you're just relegated to the accounting and reporting functions, you're not giving the best to the business.
Absolutely. Mike Scarpelli just announced his retirement from Snowflake. You work for both him and David Schneider at ServiceNow. Can you humor me and tell the story about getting hired there?
Yeah, it's a fun story. So I had kind of decided that when HP was going to sell EDS, that I didn't want to stay long term at HP. So I started talking to some of my VC friends, and they were having me go through and meet with new startups that were looking for like a VP of finance that could grow into a CFO. And then one day, a friend of mine over at Greylock Partners called me and said, "Hey, there's this company that's already public, and I know that's not what you want, but hear me out. They really need a finance person who's got operational experiences, and they're trying to make a concerted effort to scale and push into the enterprise. And I think you'd be perfect for them. Would you be willing to talk to them?" And I said, "Okay, who is it?" And he's ServiceNow. I said, "Never heard of them." And he's like,
"Service who?"
Yeah, exactly. And I said, "Sure, I trust you, so if you think it's a good." So I went and talked to David Schneider. We had a really good conversation, and it was meant to be like the first interview, an hour long. And afterwards he says, hey, can you stay a little longer? I said, sure. Yeah, I can stay longer. Because I really want you to meet Mike Scarpelli, our CFO. I think he really like you. So we walked across to the next building and Mike was there and I sat down and I thought it was just going to be, a quick meeting. That was like an hour and a half discussion. Mike and I hit on a lot of different things and really thought very similarly in a lot of different areas. Mike at the end of it said, it's been a good interview. You've got good background. Can you stay a little longer? And I said, well, oh, sure. And now this is getting to like 5:30, 6 o'clock at night. And I said, sure, what's up? He goes, Frank's still here. You want to talk to Frank?
Frank Slutman?
Yeah.
Wow.
And so I tell people is that the interview with Dave was good. The interview with Mike was better. The interview with Frank was really good. And Frank probably doesn't remember it as much as I do, but we had a good conversation at the end of it. He was very much like, hey, you need to come here. You need to be a part of this team. And if you don't, then you're stupid. So
where was your head by then? Were you getting sold on it?
I was really getting excited because they were saying things that I thought I could really make a difference. And I look, when I try to figure out where my next stops would be, it was always about the people, the product, the customer focus, and whether I could really come in and make a difference. And they really were appealing to what I thought I could offer. And so that at that point I was like, this is really interesting. So we end the meeting and we found out that Mike and Dave are arguing about who I'm going to report to. And so I told Mike and Dave, I said, you know what? I'm a big boy and I've seen how organizations that get built, they can be dysfunctional when you have sales operations and finance not on the same page. So I said, why don't I just report to both of you? And Mike said, I'm fine with that. And Dave said, wait a minute. I don't know if I want you reporting to Mike. And I said, Dave, I think that this can work. Because we need to be on the same page. We need to be aligned to what we're doing. And Dave's like, okay, let's give it a shot. And so for 6 years, I ended up reporting to both Mike and Dave. And I sat on both staffs. They both were, opinionated on my performance. And yeah, it was a great run. I started off with a group of sales ops, which was really more like order ops at the time. We weren't very sophisticated. But slowly but surely, we started building out all the major functions that I think about in terms of a go-to-market finance organization, like deal desk and pricing and sales operations and the tech stack for the sales team. And it was one that by the time I left, that organization was over 400 employees. So it was just one of those periods in time where you look back and it was tough. We had a lot of work to do, but very, very rewarding given the work that we put in. And to this day, people still come up and tell me that they've seen videos or remember some of the trainings that I gave on deal constructs.
It truly is remarkable how many chief financial officers and chief accounting officers came out of that group.
I agree. I tell Mike all the time, he should be very proud. People that I work with, and they're great people, all of them that become CFOs, and we're still in touch with one another.
Yeah. I'd imagine there's a little bit of a competitive spirit there too.
There always is, but in a good way. Way. I'm very happy for Dom, and Lisa's found a job recently, and Greg just moved into a new job. But we all benefited from Mike's great tutelage and knowledge, and I'm very happy that Mike and I still talk to each other regularly.
Well, on that note, I'm going to take you into what we call our long ass lightning round. So I ask every smart CFO on the podcast, you got to give me one thing you've messed up before.
So I saw that question and I was like, geez, there's so many. How can I pick out the right ones? But I can tell you when I was in, there was one time when I went into investor relations, and this was like 1997, 98, with the financial crisis that was hitting at that point in time. And the Wall Street Journal had called our PR department and needed a quote about basically, what Sun Microsystems exposure to the financial crisis was. What was our business like in that region? And I said, okay, well, let's find Mike Lehman, our CFO at the time. And Mike wasn't around. I was like, okay, let's see if Ed Zander or Scott McNeely, nobody was available. I was like, where was everybody? But I was the only one in the office, and they said, look, we got to stop this. The journal is on time and we need to go now. It's you. And I said, okay, let's go. So I got on with the reporter. And I gave the right answer, and there wasn't a big exposure for Sun Microsystems, but it's something that we were watching, and we're very close with our teams out there and making sure that customers knew we were going to support them. And so I thought I did a good job, and the PR person said I did a good job. Well, the next day, I got a sticky on my desk when I came in, and so please come Mike's office and Mike Landon's office. So I went over his office, and he pushed the article over and said, "You want to explain this?" And I said, "Well, Mike," I told him the story, and he said, "Here's my number. There's never a time in the future where you're going to not be able to reach me. And you need to understand that the word that you give to investors and to the markets can sometimes really move things in both a positive and a negative way." He said, "So remember that, because at some point you may be a CFO and somebody working for you may have done the wrong thing or the right thing when speaking with investors, and they need to know the same message."
That is a valuable one.
It was, and it's one that, frankly, I've kept with me, and I'm always cognizant of making sure that I'm available for our team, especially when those types comes up, and making sure they know too how best to answer some of those questions.
That's a great lesson. Next one I got for you. If you could tell your younger self something, knowing what you know today, what would you tell them?
Be more patient. I'm one of those people that when you've done personality profiles or other things like the willingness to accept change, I'm usually off the chart. And I love driving change. I'm one who doesn't pontificate and focus on the past too much, other than to learn, what has gone right or wrong and try to apply it in the future. But I don't lament. I don't regret. I push forward and focus. And sometimes in my past, I've run too fast, too far, that people lose sight of me and don't know how to act. And so I got to remember to be a little bit more patient, leave the breadcrumbs so they know where we're going, and help them along the way and understand the reasons we're making changes.
That answer applies verbatim to myself. So that's a good one. Okay. More of a technical one. Can you walk me through your finance software stack? What tools is your team using to get the job done?
It's classic for the size we are. We have NetSuite for our accounting. We have Salesforce for CRM. We use some Coatue and Workiva for integration related work. We're not super complicated right now, so there's not a lot of additional modules around tax or billing or other things that we've had to go do. But we'll deploy a PSA in the future. That's when I think you were referring to earlier, like what are you going to buy in the future? It'll be, as we build up our services business, we'll have to implement a PSA and professional services accounting system. So that's partly that. I'm really focused right now at this stage is democratizing the analytics capabilities of the company. One thing you find is at a company this stage, you don't have great data integrity and management. And I'll give you an example. Like a rep can go create a whole new account in your CRM. Well, what if there's already an existing account? You don't want them to go create a new account because that may not be in the right hierarchy. And all the things that can go wrong when you don't have, consolidated information about your customer hierarchies. So those types of things we're getting better and better at, and getting consistency, in how we define things. When I first arrived, there was a lot of, well, we define ARR in 7 different ways. I'm like, no.
Yep.
We're going to define it one way and everybody's going to use it. And it wasn't that there was anything different with respect to the accounting side. It was more of how people were cutting and redefining ARR to meet, their own needs or their own viewpoints.
I always joke with guests, like you'd be shocked at how difficult it can be to just define what a customer is.
It's funny. That's exactly one of the questions I asked.
Really?
Yeah. No, I still have my interview questions. Like, tell me how you define a customer, because you're absolutely right. And when I was putting my team through, this was at Lacework, not here at Amplitude, but I was putting my team through some of this work. I told SentinelOne had come out with a restatement of their ARR. And
I remember that.
And I told them, this is the reason. And I'll tell you exactly how they screwed this up. First, they were annualizing monthly contracts that weren't committed. And so they're making their ARR based on monthlies that didn't have any commitment. So you think about it in terms of a customer signs up to you $10,000 on a monthly. You record 120,000.
20 grand.
But they don't pay the next month that they churn. So now you're turning 120,000. So that was part of the problem. And then the other is SentinelOne got larger and larger. They started to do what I call big cancel and replace transactions. So maybe they penetrated an enterprise in a couple different spots. And the procurement person comes along and says, you know what? I'm going to aggregate all these to get the best discount I can. Logical. And it's a logical step that's happened. But if you don't have an account hierarchy that understands all the different places that you landed, when you do that account consolidation, you might miss one. And so what they did was they aggregate these contracts, but they forget to cancel the renewal that should have been part of it.
Oh,
So when the renewal came up, it was a downsell, right? Automatically, just you'd already considered it in the consolidation. So I told my team, this is the reason why we have account hierarchies, because we're going to go through this same process. And as we do, we got to be ready to capture those so we're not misstating our ARR like they did.
I had like a visceral reaction to that. I know exactly what you're talking about. And it's one of those, like, if you know, then you know, if you're listening.
Yeah. And so I immediately used that as an example for, some of the change management we were trying to go drive.
Yeah. Last one I got for you. What's the craziest thing you've ever had someone try to expense?
Oh, this one's a good one. Believe it or not, and I was auditing for Sun Microsystems at the time. This was the log, and I kept seeing these invoices for a pool company. I'm like, ooh, somebody had actually tried to expense their home swimming pool construction and implement. Yeah, exactly.
We've never had that one.
It's amazing. I remember telling Mike Lehman about it at the time. He's like, the sins of the world come through the T&E.
That should be a bumper sticker.
No.
Andrew, this has been an absolute blast. Thank you for carving out time for us. It means a lot.
Thank you for having me. I really appreciate it. Like I said, I'm a big fan. So hopefully this is some good content, and keep going. You're doing great work.
Run the Numbers is a mostly media production. Yelling and intro by Fat Joe. Artwork by Meg D'Alessandro. Show is executive produced by Ben Hillman. Nothing said on this podcast is intended to be business or investment advice. It's the sole opinion of me, a guy who feeds his dog way too much ice cream and has a history of net operating losses. LOL. If you like this podcast, hit subscribe and give us 5 stars. It will take like 2 seconds, and our algorithm overlords love it. Drink water, call your mom, and have a great day. Peace.